Hello, savvy investors, and welcome back to the Dividend Uncle channel. Today, we're venturing into a crucial scenario that might significantly influence our investment strategies for REITs. What if we are wrong, and the Federal Reserve increases interest rates instead of cutting them? Or what if the anticipated rate cuts are delayed well beyond 2024? These possibilities could reshape our approach to investing in REITs and other interest-sensitive assets. As we unfold our investment thesis and ponder the possibilities of rising rates or delayed cuts, we'll share how the Dividend Uncle plans to adapt. Remember, we thrive on your likes and subscribes, and we keep our videos clean of sponsor ads, not because we have to, but because your time is too valuable to spend on interruptions. However, those unavoidable YouTube ads aren't within our control, sorry about that. So if you enjoy our no-nonsense, ad-free content, show us some love. Hit that like button, subscribe if you haven't, and let's navigate these financial waters together with some good old Dividend Uncle wisdom. Now, let's get into the nitty-gritty of what a change in interest rate policy could mean for us all. Understanding the popular REITs investment thesis. Our investment thesis has been built around the anticipation of interest rate cuts by the U.S. Federal Reserve. Over the last quarter of 2023, from October to December, this thesis contributed to a notable 20% surge in the IEGXOPS REITs Leaders ETF. The jump was driven by growing investor sentiment and optimistic expectations that 2024 would yield substantial gains, particularly for interest-sensitive sectors like REITs. The foundation of this optimism is tied to the cyclical nature of interest rates and their impact on financing costs. Lower interest rates typically lead to reduced borrowing costs for REITs, enhancing their profitability and, by extension, their ability to distribute higher dividends. However, this forward-looking optimism hinges significantly on the Fed's monetary policy actions. Any deviation from the expected path, such as delayed cuts or, more drastically, rate hikes, could have profound implications for our investment strategy and the broader REITs market. Let's take a quick look at the impact of a rate hike on REITs. 1. Increased financing costs. For REITs and companies with significant debt, higher interest rates mean higher interest expenses, directly impacting their profitability and, consequently, their ability to pay dividends. 2. Valuation adjustments. Higher rates often lead to a revaluation of the share prices, particularly those like REITs that are valued heavily on their dividend yields. Higher rates could lead to lower share prices as investors demand higher yields for the increased risk. 3. Economic slowdown. Broadly, higher rates could slow economic activities, impacting everything from consumer spending to corporate investments, potentially leading to a slowdown in the underlying businesses of the REITs. Safe harbors, lowest gearing REITs to watch. As we brace for the possibility of a rate hike or delayed rate cuts, identifying REITs with robust financial health becomes even more crucial. Here are 3 standout REITs known for their low gearing and stable financial management. 1. Frasers Logistics and Commercial Trust, with a gearing ratio of just 30.7% and 76.8% of its debt fixed, this trust remains a pillar of stability. It boasts a global presence with 107 properties spanning logistics and commercial sectors, ensuring diversified exposure and steady rental income. 2. Far East Hospitality Trust, as a Singapore-focused pure-play hospitality REIT, Far East Hospitality Trust benefits directly from Singapore's robust tourist recovery. It maintains a low gearing ratio of 31.3%, positioning it well to capitalize on increasing tourist arrivals while mitigating financial risks. One thing to note is that it has only fixed 42.6% of its debt, which is a bugbear for me, but mitigated by the lower gearing ratio. 3. Daiwa House Logistics Trust. Despite a slightly higher gearing ratio at 35.2%, Daiwa House Logistics Trust stands out for having 100% of its debt at fixed rates, all denominated in JPY, benefiting from exceptionally low interest rates of less than 1% per annum. Specializing in state-of-the-art logistics facilities in Japan, the trust is well positioned for long-term growth. The Dividend Uncle's take: navigating uncertain waters. In the face of potential interest rate fluctuations, I will be adjusting my strategies in 2 ways while I continue to monitor the economic indicators from the U.S. Firstly, I'll reduce the tempo of my investments. Should the expectations for rate cuts extend to a later date, such as mid-2025, I'll slow down the dollar cost averaging into REITs. And I will be focusing on REITs with prudent financial strategies, such as those discussed earlier, to park my money into safer havens. Secondly, I'll increase investments in less interest rate sensitive sectors. This includes increasing investments in industries like F&B, represented by my favorite dividend stock, QAF Limited, utility stocks such as Netlink NBN Trust, and the defense sector, including stalwarts like ST Engineering. These offer stable dividends in uncertain times, and is a good opportunity to diversify our dividend portfolios. This strategic pivot is designed to safeguard our investments from the short-term volatility caused by rate uncertainties while still positioning us to capitalize on opportunities across various sectors. Conclusion. As always, staying informed and agile in our investment strategy is crucial. We must be prepared to pivot our approaches based on evolving economic indicators and Fed signals. If you found this analysis helpful, please like, subscribe, and share your thoughts in the comments below. Your engagement helps us all grow smarter and more prepared as investors. Remember, investing is a marathon, not a sprint, and preparing for all scenarios is key to long-term success.